Well, good morning, everyone. Good morning. It is November 18th, 2024. It is so good to see you this beautiful Monday morning. Monday morning, raining. That's what I meant to say. A raining Monday morning here in Central Texas. You all, so good to have you all join us for our Monday morning touch point. And let us start the day by welcoming Mr. James Sala to the team. James recently joined Team Price. It is so good to have you here. Super excited, James, that you're a part of the team. So thank you so very much for joining Team Price, and we look forward to helping you, and we look forward to you being an amazing member of the team. So welcome aboard. Always good to see amazing people joining the team and seeing the team grow. So super excited to have you a part of the team. And y'all, I want to remind you that today is Christy's birthday. So if you get a chance, send her a message on Facebook, send her a text message, send her an email. Today is her birthday. Y'all, I am just really excited this morning. Long evening. My flight landed at 3 a.m. this morning. So we touched down like at 2:57 or something like that. Just got off the plane after getting all the hockey gear. I made it home by 4 a.m., got all the laundry done, went to bed at 5, woke up at 5:45. So I feel absolutely fantastic this morning. Hey, if you're here, I'm here. So that's what I'm saying. It is good to have you all here. You all, lots to go over this Monday morning. I want to remind you that we are having our mentorship meeting tomorrow morning live here at the office, 10 a.m. Be sure to join us for that. That's going to be great. We also have our Wednesday contract review, broker Q&A. Send me emails. Any broker Q&A questions that you have, go ahead and send me emails. I will address those on Wednesday. Of course, if you are dealing with a live contract and all that, please obviously give me a call. But if you have any general questions about contract, the industry, or really anything, oftentimes y'all will even send me links to articles like, hey, what do you think about this? How does this affect real estate? Please go ahead and send them my way. And then we're going to do the contract review from last week. Last week, we did a Triplex contract, which is a little bit interesting. And one of the ways that we're going to review that Triplex contract is the contract proficiency was you come up with the price. It's your choice, agent. You come up with the price. And how hard is it to identify the price of a income generating asset when there are no comps? How many triplexes are there in the Austin area? Not many at all. That's why we chose that property. So I'm going to share Wednesday a few formulas that you can use to identify the value of an asset. Do we use the cap rate? Do we use a gross rent yield? Do we use the 1% rule for investor? How do we define the income that property is generating? How do we backtrack using a percentage, whether it's the gross rent yield or the cap rate or the 1% rule? And how do we come up with an offer that we can present to the seller that makes sense for our investor client, for our buyers? So that's going to be on Wednesday. Be sure to join us for that. And then, of course, we have Friday, our team meeting. So this week's going to be one of those kind of regular weeks. We did not have a Friday team meeting this past Friday, but we are having a Friday team meeting this next Friday. And based on the feedback that I received from you all, I want to point out two resources that I went ahead and launched. One of them is, let me go ahead and just find that right here, Investor Metrics. I found this to be the best title for this resource. This is the information that we went over this past Wednesday, which is a guide for us, for realtors, for investors, understanding the 1% rule, gross rent yield, cap rate, and cash flow analysis. And the whole idea behind this is that you go from very simple, very superficial to the final decision of an investment property, and that's going to be your cash flow analysis. So you start with the 1% rule, simple, no complexity. Then you go to the gross rent yield. That's basic. Then you go to cap rate. That's intermediate. Then you go to advanced, which is the cash flow analysis. And the good news is that we have all these tools available for you. So you all do not be intimidated by these words. We in the business, we have to know what a cap rate is. We have to be able to calculate cap rates. We love investors. And as the cap rate in the area improves, and it is improving, it's going to continue to improve. We are already seeing investors coming back into the Austin area. We're at the very beginning stage of that. I would say that it's going to pick up over the next 12 to 18 months as prices continue to stabilize. But we're already seeing money flowing outside of these markets that have peaked last month, 2 months ago, the Midwest, the Northeast, California. And that money is coming back into our market via 1031 exchange. So we have to be ready. That's why our contract proficiency, we're just focusing a little bit more on some of these investor terms so that we understand exactly how to work with investors. So this is a really good resource available for you that gives you an entire definition on what all this means. The other thing that I want to point out is that I went ahead and superimposed the mortgage rate on top of the national market index. Let me go ahead and go to the national market index. Here we have it. We have been tracking this data, not all the way back to 1900, but we have the data going back to 1900. But I've been tracking this since I got into the business in 2004. And here we have, and this is all the different cycles. This is the home price index adjusted for inflation, HPI divided by CPI. This is released once per month. So an idea that we had last time we met was to superimpose the mortgage rate with the HPI adjusted for inflation. The reason it's important for us to understand this data is that we've got two little points right here. We've got this one little, you see that little dot? Let me go ahead and make this a little bit bigger for you. See that little dot right there? This little dot, and I'll still clean this up, add some definitions, but I just really wanted to get this published. That little dot is when the Fed started buying mortgage-backed securities. First time since the Fed was launched in, 1913? First time they started buying mortgage-backed securities. In my opinion, a catastrophic decision. They should have never done that, but what do I know? They did it. That's when they started. That's when they ended. They started buying mortgage-backed securities right there towards January 2009. They announced it November 2008. The second they announced it, look what happened with rates. It just plummeted. It kept on going down. They eased on buying mortgage-backed securities. Rates started going back up. They started buying mortgage-backed securities and they stopped and they started again. And of course, they announced we're not going to do this anymore. And then they officially stopped right there in 2022. And here we had a period in human history, in U.S. monetary and finance history, where we've never experienced low rates this low because they were subsidizing the mortgage market. At one point, they were buying over 40% of all mortgage-backed securities. When demand goes up, what happens with the price of an asset? The price goes up. If the price goes up, what happens with the yield? The yield goes down. What's the yield? The yield is the mortgage rate. That's why we notice this going down. The reason why I am superimposing this HPI graph with mortgage rate is to dispel the notion that if the Fed continues to lower the overnight lending rate, and even if they start buying mortgage-backed securities, that overnight we're going to see a run-up in real estate prices. History does not show that that's the case. You can see that they started buying mortgage-backed securities in 2009, January 2009, and rates were going down. But what happened with prices? Did prices all of a sudden start going up? No. See, everyone right now is saying, oh, if rates go down to 4.5%, prices are going to shoot up. Well, that's not what happened here. Rates went down, and what happened with prices? Prices kept on going down. Pricing in real estate is simply a function of what people make. This is for the entire country. Keep in mind, this is not Austin. We are way ahead of the curve. We are 18 to 24 months ahead of the entire country. So as rates go down, and as of now, no indication that apart from Fed intervention, rates are ever going to get under 5%. It ain't going to happen. Rates right now, apart from Fed intervention, it's right here. This is what we're looking at. We're going to have little peaks reaching 8%. We're going to reach close to 6%. But right here, this is it. 6.25 up till about 7, pushing at 7 1/8. These are market rates right now. The only way we ever get back to this is if the Fed starts buying mortgage-backed securities. I don't want that to happen. I think that destroys long-term real estate stability. But I'd say that they are going to do that. But I don't want that to happen. But even if they do that, we can still expect at the national level prices to continue to go down. Everything reverses back to its mean. So that's why we superimposed the rate with the chart, because you hear me talk about this, but only when you actually see the data or you kind of convinced about it. So these are some of the resources that we've updated over the past few days. You all keep on sending me ideas on how to make our data in our resources better. 90% of everything that we have is because you all asked for it. So anything that you see that needs to improve, if a chart doesn't make any sense, if we need definitions, if we need clarity, or you go to a listing presentation, you go to a buyer presentation, and you're like, hey, I was asked this question, and I really couldn't find what tools and resources to equip my client. Reach out. Let's see if we can create that. So please go ahead and do that. Reach out. Give me some ideas. Help us improve. So that's a really quick update on some of the really exciting resources that we continue to make available and publish for you all. Yeah, let's go ahead and jump right in, start updating the new listing to pending ratio. As you know, the single best leading market indicator available for our entire area. Very simple ratio. I love simple. Simple is effective. We don't have to complicate stuff. This ratio is where we add new listings plus back on the market, and then we divide that by everything that went under contract, active under contract plus pending. So we've got new plus back on the market divided by active under contract and pending. That's going to give us this very simple ratio. And the whole idea behind this is that if you have a ratio of 1, that's that perfect market equilibrium. 1,000 homes came on the market, 1,000 homes left the market. Inventory, apart from withdrawals expireds, neither goes up or goes down. We're simply looking at the consumption side of it. What's going under contract on the number of properties. If a ratio is under 1, that means that less properties went under contract in relation to what came on the market. If the ratio is over 1, that means we had a higher demand in relation to what went under contract. A 0.75 ratio puts us at that neutral market. You know, its inventory just creeps up just a little bit, not too much. You go into the 0.85, nice, healthy market. When you're under 7, getting closer to that 0.6 to 0.65, that's going to give us that tangible increase in inventory. Under 6 is going to give us a substantial increase in inventory. Under 5, the market's crashed. When you get a ratio under 0.5, it's watch out. The market hit a wall. Nothing is moving. Ratio on the 0.4s, forget about it. We're all getting other jobs. Like nothing's moving. So let's go ahead and update the previous few weeks. And the reason why we do this is because new price increase, price drop back on the market, active under contract, locks Monday at 11:59. So we don't have to go back and update these. When I update this information on Tuesday morning, all these figures are locked forever. Pendings will continue to update. Agents are really bad when it comes to updating pendings. So we have to go backwards in time a little bit, and we have to update the pendings for the past few weeks. I want to remind you that we pull residential properties. This is residential, and we also focus on the 6-county area: Travis, Williamson, Bastrop, Hayes, Caldwell, and Burnett counties. So we're going to go pending. We're going to go from the 4th to the 11th, and that's going to bring this number up from 310 to 317. That's going to give us the same thing, ratio of 0.74. Then we're going to go backwards in time a little bit. We're going to go from the 28th to the 4th. That's going to give us a ratio of, let me go ahead. Let's just see here what's going on. This is from the, okay, so here we've got 28th, October 28th to the 4th. And that, so this is going to be residential 6-county area. This is actually interesting. This is going to be 368. That's going to be 0.78. Oh, I know why. Some of these figures, this is going to be 329. And let's go from the 14th. This is going to be 274. And from the 7th. And this is going to be, oh, let's see. What's going on? Residential pending. Oh, you know what? Let me go back. This is, I'm going to go to search more. Sorry, I was actually clicking on the wrong tab. So we're going to have to go back and redo this a little bit. Let's go to the 6-county area. I was like, these numbers look really low. So we're going to go from the 4th to the 11th, and we're going to do pending 6-county area. And this is going to be 340. From the 4th to the 11th, 340, 340. Then we're going to go from the 28th to the 4th. Okay, perfect. We're back on track. This is going to be 430. Then we're going to go 21st to the 28th. This is going to be 427. 14th to the 21st. 435. Let's keep on going. Sometimes we have to go back like 6 weeks. 470. Great. This is the latest and greatest. I was clicking on broker productivity instead of the actual full search. So there we have it. Maybe I need more than 45 minutes of sleep. We've got last week, 0.77 ratio. Week before that, 0.85. Week before that, a 0.96, which is the best ratio that we've had going all the way back to January 22nd through January 29th, where we had a 1.12 ratio. The reason we had a 0.96 ratio is because we had a pitiful number of new properties come on the market. From October 21st all the way through October 28th, only 749 new listings came on the market. That drove the ratio up because that ratio is new plus back on the market divided by active under contract and pending. So when you've got less new listings on the market, even though you have still less properties under contract, that ratio still is going to go up. So we are back to a 0.77 ratio. That puts us at the, 0.75 is really that line that transitions us from the tangible increase in inventory to slightly on the substantial side of things. You can see that it's a plus 225 difference between everything that came on the market as opposed to what left the market. 225, a little bit on the high side. It's going to go down a little bit as agents update properties that went pending. Overall, I would say, well, let's compare week over week on the next chart. Let's start updating this week. 11th through the 18th, number of new listings. Oh, wow. Y'all, we are seeing new listings come back on the market. 791. 791. So here we've got the highest number, and this is only 10:19 a.m., which means we're going to cross 800. We're going to settle around 825 or so new listings coming on the market in the past 7 days, but we are seeing an increase in new listings hitting the market, 791 right now. That is a higher number that I was expecting, especially for November. Let's go to price increase, 143. Price increases. And by the way, you all, take a look at that 250. That 250 builders, right? 90% of these 250 properties that had a price increase back from October 28th all the way through November 4th, builders. And we are already noticing, now that we're 2 weeks after, we're already noticing those same builders coming down on price. I hate that strategy. I think that's such a dumb 1980s sales tactic. Buy now because prices are going to go up at the end of the month. Oh my goodness, I've been hearing this for 20 years now. And then what do? 2 weeks later? They start cutting the prices of those same properties that they raise the prices. But they keep on doing that. They're never going to change. Price decreases, we are at 1375, 1375, 1375. Oh my goodness, 1375. That's going to put us at 91%, matching last week. Back on the market. Back on the market, 118. That's a low number, 15% back on the market. Wow, that's a crazy low number. We haven't seen a 15% back on the market. I have to go all the way back to June. We had a 16%. We had 15% back in April. Very low number on back on the market. And that right there is also a leading indicator. If you have a lower back on the market, does that show you a strength on the market or does that show you a weakness on the market? It actually shows you a weakness on the market. And the reason why is because buyers are able to negotiate more concessions with the seller. The seller wants that contract to hold firm. The seller's willing to give more concessions to the buyer. Therefore, the likelihood of the property coming back on the market actually decreases as opposed to it going up. You look at the peak of the market when the market was just on fire. And let me go ahead and just adjust this just a little bit so you can actually see. Look at this. Look at the peak of the market when things were on fire. 1.1 ratio, 1.2, 1.2. Look at the back on the market. 30%, 40%, 46%, 48%. The hotter the market, the higher the back on the market. One is buyers feel like they overpaid. So when the market was crazy, insane hot, look at these numbers, 41%. When the market back in December 20th through December 27th, 2021, we hit a 1.83 ratio. And that was the highest ratio. Okay, we had 1.86. Well, look at this one. 1.86 ratio back February 15th through February 22nd, 2021. Look at that back on the market. 55% back on the market. And for us who were in real estate back then, why is that? Well, buyers felt pressured. It's like, I got to submit an offer. It's got to be $50,000 over list price. Buy. And then they get under contract and then they sleep on it. Then they go and they do the inspection on the property and they're like, oh, well, what's going on here? And I don't like this and I don't like that. And then that seller has a backup offer. And the other thing is that buyers will submit. The hotter the market, buyers will submit multiple offers on multiple properties. And then they pick one. So they'll send 5 different offers. 3 of them go under contract. They do the inspection on all 3. And then they basically pick one. So what happens? The back on the market increases because they're going to terminate the other 2 that they don't want. So the hotter the market, the higher the back on the market. So when we see the back on the market dropping, and you can see here where we went from 40 to 27 to 17 down to 14, what happens with the ratio shortly thereafter? The ratio starts to drop. So now that we're seeing back on the market, we've been going all the way back to June, we've been at an average of 22. And now we're at 15. So the back on the market is starting to drop. What does that tell us? Buyers are getting the concessions from the sellers that they want. When they do that inspection, they ask for that insane amendment. I want an extra $10,000, $20,000 off, and I want an extra $5,000. I want you to replace the roof, and I want you to do everything. And the seller's like, I've been on the market for 70 days. I haven't gotten another offer. This is the only offer that I'm working on, the only offer that I have. Give it to them. I don't want this deal to come back on the market. So something for us to keep in mind, you all. Let's go to active under contract. We're at 414. That is a just incredible number. Wow. Active under contract, 414. That's the best active under contract going back to October at 455. And keep in mind, it is only 10:26 a.m. So we've got between now and 11:59 for this number to keep on going up. Is it going to beat the 455? I'd say it will. So I'd say we're going to have the best active under contract going all the way back to September. Very interesting. Now, this is where you get to guess, you all. This is where you get to guess. I need 5 people, 5 volunteers to write down over chat your guess on how many pendings we've had over the past 7 days. Keep in mind, this is going to be a little bit on the low side of things. You know that this data is updated for the next few weeks. Sonia is going to start us off at 225. Sonia, 225. Melanie at 298. Harold coming in at a very bearish 210. Wow, you've got a lot of people here. Must be raining outside and you've got nothing else to do. We've got Aaron at 267, Charmaine at 265, Renee coming in at 250, and Seth at 217. Let us take a look. We have Bertina at a very bearish Bertina coming in at 185 or 199, Rob at 185. Sonia Komisarenko won the prize, if we had a prize. Sonia, you're spot on. 225. 225, you all. We're starting off the day at a 0.70 ratio. Not bad. Not a bad ratio. It is true. This is not... Sonia was spot on last week. Would you have access to my data, Sonia? That's probably what it is. Good for you, Sonia. I love it. 225, you all, and we're at a 0.70 ratio. That is not a bad ratio, especially with a 791 new. We are seeing demand increasing in our area. And wait till you see the pricing. The pricing right now, what is closing for the month of November, is mind-numbing. It doesn't even make any sense. So I can't wait to share with you the market cycle to show you what things are selling for this month. It doesn't even make any sense. Let's go ahead and take a look at the year over year. Let me adjust this a little bit so you can see the entire thing. We already have year over year, same week, year over year. We already have 42 more listings this week than we had exactly 1 year ago. We've got 43 more price increases this year compared to a year ago. We have 187 more price drops this year compared to a year ago. 48 less back on the market, 4 more active under contract. And so far, we've got 285 less pending. This number is going to shrink quite a bit, but take a look at last week. Last week, 93 less pending. So we officially broke the trend going all the way back to August, where now we have less properties. When you add active under contract and pending, we've got less properties that went under contract 2 weeks ago compared to the same week last year, while we have more properties that are new on the market. And now this week, we've got more price drops. And then you take a look at the back on the market plummeting down to 15%. Be cautious out there on your listings. This is where we have to understand leading versus lagging indicators. This is where the market is very deceptive for agents. When I say that prices are through the roof for the month of November, we have to remind ourselves that these are closings based on activity that happened when When did these buyers start looking for homes? If it's closing in November and the price is hitting the MLS in November, when did that buyer reach out to you and say, I want to start buying a house? When was that? July? August? Went under contract towards the latter part of September into October, now closing in November. So if you have 45 days to close, and the number of days to close is increasing a little bit. We used to average 27. We're averaging right now about 33 days across the MLS. So let's just say you go from 35 days to close. Well, what were rates like back in September? That buyer more than likely was able to secure that more attractive rate. Now those deals are closing. So the lagging indicator is unbelievably positive, which is causing more sellers to put their homes on the market. That's why we're noticing more new homes on the market. It's like, oh, wow, we took our house off the market back in June because the market was stalled, and now my neighbor's house closed for $20,000 more because it just closed in November. Let's put our back on the market for $25,000 more. Things are back to normal. Lagging indicator. Agents that are purely relying on lagging indicator, it's going to bite them because that property is not going to move. So don't discount the lagging indicators, but be obsessed with the leading indicators. Leading indicator, things are pulling back. Well, why is that? Rates. It's all about affordability. It's all about rates. And we're now at a 7%. And I'll show you Robert's amazing weekly update. Let's start updating the monthly data right here. We're going to go backwards in time. We're going to go to month of October, see how many pendings. 1664. We're going to go to September and see if any agents are lagging on updating September. This is going to be 1835. Let's go to August. This is going to be 1863. Let's go to July. This is going to be 1801. Wow, agents are so bad on updating information. It's unbelievable. Let's go to June. But that's why we have the accurate data, is because we make sure it's accurate. We've got 1862. Let's go to May. Goodness. May, we are looking at 2020. Oh, wow. Let's go to April. We're looking at, okay, now we don't have to update anything else. October, last month, 0.78 ratio. That's when we saw rates starting to go up. We went from the average rate for the month at 6.18. That drove the ratio up to 0.8. Nice, healthy ratio. And then rates started going up. The average rate for October, 6.36. And the average rate for this month now, 6.79. That's the average rate for the month. A little bit on the low side because we're using Fannie Mae's rates, and that's always a little bit lagging. We have, as of this morning, 11,819 active properties across the 6-county area. And let us start updating all of the data. New listings, 1768. Price increase, 436. Price decrease, 2877, 87%. That's going to be the best number going all the way back to March. Back on the market, 326. There's that drop. There is that 18% drop right there, 18% drop. And you can see 18%, this went down, and what happened to the ratio? 0.67. See? We went 14% back on the market. What happened 2 months later? The ratio drops. So here we've got a drop in back on the market. What's going to happen to the ratio in the next 30, 60 days? Guarantee you it's going to go down because sellers are giving concessions. Sellers are seeing, I'd say a lot of listing agents are seeing the writing on the wall. They're not getting the showings they were getting 2 months ago. That's what's happening. Active under contract, 872. And we've got pending, 656. There's that 0.73 ratio. We peaked at a 0.80 September. That's when rates were at 6.18. We got down to 6%, but the average for the month was 6.18. We now backtracked to a 0.73 ratio. November of last year, we were at a 0.82 ratio. December, 1.08. Right now, 0.73. Let's take a look at sold. How many sold so far this month? 1267. How many withdrawn? 507. And let's take a look at expired. 239. It is normal for us to see withdrawns backtrack for the month of November and December. It's very normal. Take a look at last year. We hit 972 in October, then we dropped to 932 and then 819. But what happens with expireds? It goes up. What happens is sellers are like, well, why would I withdraw October 8th or November 18th when it's just going to expire at the end of the month, at the end of the year anyway? So let's just wait until it expires. A lot of listing agreements end December 31st. A lot of the listing agreements that were initiated between the first quarter and the middle of the second quarter will terminate December 31st. So you've got a drop in withdrawns, but you've got an increase in expireds when you go into December. Very normal. But so far this year, you all, 12,710 properties have withdrawn and expired so far this year. Statistically, when we pull the data, we can see that 27% of those will be relisted within a 6-month period. 27% of those. So if you take a look at the properties that withdrew and expired from July to November, you're looking at 7,000. So roughly 2,000 of those will be relisted first quarter. That is a statistical fact. That's what's going to happen. So we've got a 0.73 ratio right now. I will have all this information published as a PDF. Let me go ahead and just save this and close it so we can review a few other things. You will receive an email summary from me here in the next hour or so with a video with everything. And within the next hour, when you go to Insight and Statistics and you go to New Listing to Pending Ratio, you will be able to get the 57-page report with all of the graphs, with all of the heat charts, with absolutely everything so that you can prepare for this week, prepare for your listing presentation, buyer presentation, or just overall just study the market. So this will be updated within the next hour or so. Let's take a look at rates. Let's take a look at the bond market. Robert kindly sent us his rate sheet for the morning. We're at 7%, conventional 30 years, 6.625, conventional 15 years, 6.25 for both VA and FHA. USDA, same thing, 6.25, 7 1/8 for jumbo, which is not a bad rate for jumbo. Investor, not bad at 7.625 with 20% down and 1 additional point. As of this morning, the bond market looks to be a little bit higher in the yield. Okay, we almost crossed a repricing line right there. We started the morning, shot way up. That was the highest reading going back 5 days. Let's go back a month. It would have been the highest reading going back an entire month. It would have been the highest reading going back 3 months. And we would have had to go all the way back to May for a bond market yield that was higher than what we had this morning at 0700 hours. But thankfully, as data was published, we noticed a big, nice, decent pullback. So we are now really nice and far away from that repricing line. Not quite crossing this repricing line, but we are up only 0.5 basis points on the 10-year Treasury. Well, let's take a look at the economic calendar and see what in the world is going on that is causing this. Let me make this a little bit bigger so you can see it. And we've got the National Association of Home Builders Housing Market Index. This was just published, hotter than expected. Now that this was published at 0900 hours, I will be able to update this data point, the MBA Purchase Index. When you go to the MBA Purchase Index and you go to the last few pages, we have the traffic of prospective buyers. This number comes from the National Association of Home Builders. Now that they publish their figure, I'll be able to update this later on today. I guarantee you that this number went up from 29. That is why we have the National Association of Home Builders Housing Market Index going up. Keep in mind, this data is published in November. Guess when this data is from? This is a survey that's done by the National Association of Home Builders. They survey 900 home builders. But guess when? It's a lagging indicator. So they're telling you in November what October was like. October is based on September demand. What happened September? What happened October? We had a better rate environment. Still very good to see this rate going up. This has been going up since August. So it's really nice to see this go up. Now keep in mind that November of last year, we were at a low of 34. So the fact that right now we're at 46 is really encouraging. This is great. Way better environment compared to, this was 2023. Here you can see November 2023 at a 34. So we do have a better environment for builders this year compared to last year. But we also have a better rate environment, which is fantastic. We've got some bond auctions came in exactly on both the previous. This is very strange that both the 3-month and the 6-month would come in exactly the same. But let's take a look at this week to see what's going to happen this week. We've got building permit. That's going to come out tomorrow. We'll be able to update the building permit section of our website tomorrow. We've got mortgage applications. This is out on Wednesday. Crude oil inventory. We've got, some manufacturing data. We've got existing home sales. And we've got consumer sentiment, Michigan 1-year inflation expectation, consumer sentiment. This is fairly important. Not the biggest, most consequential week when it comes to the bond market. Let's see what's going to happen next week. Next week we've got, love it, next week Tuesday. This is where we get to update that home price index divided by CPI. Love to be able to update that. We've got consumer confidence next week. We have PCE, preliminary PCE inflation. We've got preliminary GDP. We've got core PC. So very important week next week. Very important week. And then oh my goodness, are you kidding me? Is Thanksgiving already? No, there's no way. Thanksgiving is next week, you all? Are you kidding me? Is this true? Thanksgiving is next week. Oh my goodness. I did not realize that. This is crazy. It doesn't feel like that. I don't need sleep, Sonia. I'm going to sleep when I die. Hate sleep. Sleep is a waste of time, if you ask me. So, not the most consequential week this week. Very important week next week. So that's what's going to happen. Hopefully we will. This is what's going to happen. I'll tell you right now. This is going to be super volatile this week. We're going to end Friday with the same reading, very similar that we had the previous Friday. We are looking at best case scenario. We backtrack a little bit. We get about 6 7/8 into the 6 3/4. Worst case scenario, we stay at 7, might get up to 7 1/8, 7.125. This is the new range that you've got to be comfortable. This is the new range that your clients have to be comfortable. We're just going to bounce up and down from that. And that's just the new reality when it comes to rates. Now, let us take a look at active inventory. We have, as of this morning, 13,678 new listings. That is a gain from Friday of 41, which was a gain of 30. We are down 132 week over week, but take a look at the previous Friday. We were down 216. We're down 801 month over month, but look at last month. We were down last Friday, we were down 863. Year over year, we're up 14.4% year over year, the highest reading going all the way back to October 31st. Is stuff sinking in? So we've got a little bit of a pullback on properties going under contract. We've got pullback back on the market. We've got a little bit of an increase on properties that are having price drops. We now have an increase in inventory. In what you just have to start putting the puzzles together. I don't just rely on one data. It's like, okay, well, what is everything pointing to? And everything is pointing to just a little bit of a pullback. So keep that in mind, because when we go over the market cycle report, it is going to shock you because it shocked me. We have less than 4,000 pending. We've got 4.8% more pending today than we did last year, but we got up to 9.7% October 31st. That was cut by half. We're at 4.8% right now. We've got an activity index of 22.5. We got up to 22.8. Months of inventory at 4.86. We got down to 4.8. Now we're at 4.86. So if you were to plot every data that we track and you were to say, okay, the 25 data points that we track, how many of them are pointing to just a little bit of a temperature drop? Well, like 23 out of 25 are pointing just to a little bit of a slowdown there. So you've got to take that into consideration as you engage with your clients out there in this market. When you look at the activity index, pending divided by active plus pending, new construction 30.22, resale 18.79, and take a look at a little new record high right there. What do you see right there? 34 short sale. We now have a most recent high on short sale. Still super low, by the way, unbelievably low, but 34. So we're consistently over 30. We have 510 properties that fall within the special listing condition. That's 3.73% of the entire market. Let's take a look at active listings. You can see this little bit of an increase on active listings. We are up 14.4% year over year. Pending listings, we're up 4.8%. Activity index, little bit of a drop right there. Last year we kept on going up. Now a little bit of a drop. We are down on the activity index 5.1%. Months of inventory, we are up 16.2%. Out of all of the 13,678 active listings on the market, 54.2% of those experienced a price drop. Now, make sure you're sitting down for this bad boy. This is unbelievable. Y'all, we are looking at a month over month, so far this month, average sold price increase of $28,819, 5.2%, year over year. I mean, I so didn't believe this number that I deleted everything and re-imported the data just to make sure that it was accurate. Then I didn't believe it. So then I went to the MLS and double checked it. Then I went through the list of like, okay, clearly someone marked that a $600,000 house sold for $6 million. No, this is the number. So far this month, November 18th, we are looking at a year over year average sold price increase of $50,000. $1,134. I about just fell off my chair when I saw this number. A 9.3% year-over-year increase. The median sold price up $17,100 month over month, up a staggering $27,000 year over year. To put this in perspective, let's take a look at the month over month. Month over month is going to put November as the second best November on record. We have to go all the way back to 2005, where we had a 6.5% month over month increase. And this is going to match March and April, month over month of last year at 5.2%. Year over year, we're up 9.3%. Just unbelievable. Unbelievable. Because it's not like we can say, well, only the multi-million-dollar properties are selling. Well, no, because the median is up. The median is up at an astronomical rate. Month over month, the median is up 4%. Year over year, this is going to be the best year over year median sold price going all the way back to July of 2022. Any thoughts as to why? A few things. When you look at the distribution of properties, right? So think about kind of like the bell curve, right? And here you've got your median. And your median could be the same, and you could have kind of like a high up and then like a low tail. And then the median could be here, and you could have kind of one of these. See what I'm saying? But the median is still the median. And these two markets will be dramatically different, right? This is like your textbook kind of perfect distribution. Same number of properties will sell. And realistically, this line will actually be kind of a little, let me redraw this line to make it more accurate, right? So like this line will be here, this line will be here. And the whole idea is that on this side, you've got more properties that are selling less than, like the bulk of the properties selling less than. And then on this side, you've got more properties selling greater than. That's the bulk of these, less than and greater than. We are seeing right now, Seth, more of this, where we don't have an astronomical number of properties selling. We are up on the number of properties compared to last year. Last year, fourth quarter was brutal on the number of sales. So we are noticing an increase in the number of sales, but we are noticing more expensive homes selling. We're also noticing more cash sales going on compared to a few months ago. More conventional sales going on with higher down payment. So that's what I can attribute this, but still this number is unbelievable. It is a shockingly high number. The challenge with this number is that this is the 50,000 foot level number. This is the entire 6-county area. This is why it's so important for you to drill down within your zip code, your subdivision, your street to see exactly what's happening there, because we are seeing that tale of two markets. Some areas are doing very well, other areas really not so much. When you look at the median sold price, we are now down 18.73%, but this is going to be the best year-over-year reading going all the way back to 2022 July when we had 7.3%. Unless there are just an obscene number of cheaper properties, Seth, that will sell between now and the end of the month. And keep in mind, we've got Thanksgiving, so nothing's going to happen that Thursday and Friday. But unless we have this obscene number of cheaper properties, it's going to be an unbelievable month. I mean, sales-wise, pricing-wise, this is just incredible what's happening with pricing. Now, let's take a look at the number of properties sold. Last month was a really, really positive month, 2,425 properties sold. That was the best October going back a few years. The forecast this month, 2,067, that's going to go up. And the reason why the forecast is a little bit lower is because Thanksgiving is happening towards the latter part of the month. So we are going to notice a pullback on the number of sold properties. It'll cause some of those solds to go into December just because of how Thanksgiving is being timed right now when you look at the calendar. So that there's going to be a little bit of a pullback this month on the number of sold properties. But let's start adjusting this for population. When you look at the cumulative number of sold properties adjusted for population from January through November, we're at 1,122. So we are down year over year on the cumulative sold properties. And let's take a look at the number of realtors. Number of realtors, number of sold properties per 1,000 realtors, we are actually up just a tad. So everything that sold from January through November divided by 1,000 realtors, 1,456 properties sold per 1,000 realtors. Last year from January through November was the worst year on record. Worst year on record. And so far this year, we are up compared to last year. That's going to continue to be the case. Type of market, out of the top 75 zip codes that we track, 41% or 31 are in a seller's market. 24 or 32% are in a neutral market, and 20 or 27% are in a buyer's market. When you look at cities, 40% out of the top 30 cities, or 12, are in a seller's market, 37% in a neutral market, and 23% in a buyer's market. Let's take a look at activity index. And let's look at the historical activity index. Let's look at the highs and the lows and discern what's happening here. Austin, little bit of a pullback from last month to this month. Last month, we hit 20.1% activity index, pending divided by active plus pending, a leading market indicator. We've got a pullback to 19.7%. Bastrop in Buda, record low activity index going back 12 months. Buda is a little bit shocking, 23.1% activity index. We've got an activity index in Buda right now that is almost half of what it was last year. All right, Buda, where are my Buda agents? What's going on in Buda? Like, why are we noticing a collapse in the activity index in Buda? What the heck is happening in Buda? Like, Buda was killing it up until February, and then we started noticing a slow decrease, and then it just absolutely plummets. Maybe they're going to Kyle. They're going to South Austin instead of South Austin. I mean, what's going on in Buda? Where are my Buda agents here? Can you explain to us what's happening in Buda? Like, just Kyle's very competitive compared to Buda in great builders. Okay, well, there you go. Sonia knows that area very well. So you're noticing buyers that are like, hey, I'm just going to go to Kyle. Okay, Kyle, terrible. Well, let's take a look at Kyle. What's going on with Kyle? Kyle, we're looking at... Well, you know what? Look at the activity index in Kyle. Picked up. It dropped down to 26.1 in July, and now it's at 29.7. So you've got a drop in activity in Buda down to 23.1, and then you've got an increase in activity in Kyle. So it looks like the demand is going towards Kyle instead of Buda. West side of Kyle is great. I love it. That's hilarious. So let's take a look at months of inventory. Going back a few slides, do you think the increase in activity in the market could be evidence that the market correction is closer than the 11.21 we are seeing on the median price versus inflation adjusted chart? Let's go back to the median price versus inflation adjusted. That's going to be under affordability. So what I have to do is I have to go to the Team Price website, Insight and Statistics. Then I have to go to affordability. Then I have to make it a little bit bigger. Then I have to go all the way down. And then I have to go up a little bit. Let's take a look at that. All right, the market peaked April, May 2022, and it's down 18.73%, or $103,000. Based on this analysis, it's reasonable to conclude that the market will correct an additional 11.21%, or $50,111. I would say this. I would put this under the worst case scenario. Right? It's this really would be like a worst case scenario, another 11.21%. I would say it would be reasonable for the market to not only correct by 11.21%, but also potentially to overcorrect. That would be a reasonable thing. Real estate markets tend to overcorrect, and we can see that historically, that's exactly what happens with the market. The market historically will overcorrect. And where is that? Let's go find that right here. No, which one do I want? Let's find the market overcorrect. I think we're towards the back of it. Oh, it's rent versus buy. That's where it is. Rent versus buying. Renting versus buying analysis. And we can see right here, I like this chart. This is where the median PITI compared to the median rent. And you can see that at this point, it was cheaper to buy than to rent. And then more expensive to buy than to rent, went down to 9.6, went up to 67. I am, like you know me, a mean regression theory guy. So I say that this line has to go down and it will reach that 15%. That only happens if we have a catastrophic drop in rates or if we have a continued drop in price or the combination of the two. And I would say I'm a contrarian. And as bullish as I am for the month of November, it doesn't make any sense. It almost feels irrational that we would have such a dramatic increase in the median sold price and the average sold price all of a sudden out of nowhere. Almost like this return to normal euphoria, and we can see that by this chart, is that we now have our first, second, and third return to normal. And it feels that way. It just feels euphoric. It's like, oh, things are going to go back down. Things are going to go back. Wow, prices are going up. But you can see that the trend line, when you peak these three return to normals, kind of goes down. So I would say it's just very reasonable just to kind of see a delayed market correction, especially now that the nation is catching up to Austin. And if the narrative becomes, oh, wow, prices are now going down, and Austin continues to buy into that, then we can expect more of a slowdown. So even though we're having a crazy good November, we've experienced this before. Like, oh, wow, return to normal. Oh, never mind. Oh, wow, return to normal. Oh, never mind. Oh, wow, return to normal. I would say, Aaron, as much as I don't want this to be true, I would say that we are going to come February, March, April, we're going to say, oh, never mind. That's what I predict. And we're going to get closer to that inflation adjusted price. And it's not that I don't want that to be the case. I just think that that's more on the fundamental side of things. What are your thoughts? What do you think? Let's go find that again. What do you all think? Anyone? Agree? Disagree? Wait and see? What are your thoughts? I know it's raining outside. I know you haven't had your coffee. I know you're tired because you landed at 3 a.m. and got home at 4. Aaron, go for it. Oh, for some reason I can't hear you. Can y'all hear Aaron? I cannot hear Aaron for some reason. I cannot hear you. I don't know what's going on. Okay, y'all can hear him. You're gonna have to like transcribe or something. Let me see if I can figure out a way. Okay, can you talk again? Yeah, I can't hear you. I don't know what's going on. You're gonna have to type. Sorry, bud. But if everyone could hear you, then I'm sure it was fantastic. No updates though. No Zoom updates. So I don't know why in the world it would say it would basically not allow me to hear you. But I will definitely read what you have to say so we can capture the breadth and wisdom of what you're about to say. I will read that for everyone. It does seem like there's a reaction to the low prices that are happening. Yeah, no doubt about that. But at the same time, if the activity was driven by the lower prices, then we would see at the very least the median stay the same as opposed to such a dramatic increase in the median price. That is the irrational part of what's happening in November, is that everything is up. It's just shocking how much November is up. Now, I get it. It's because of activity that happened when rates hit a lower amount and people were able to buy more real estate. Their affordability increased because rates went down, but it is just downright shocking to see how much it's going up. Let's take a look at zip codes really quick, do a little bit of a year-to-date comparison, which ones are hitting highs, which ones are hitting lows. Across the board, we've got quite a few improvements. We've got a little bit of an increase downtown Austin, a little bit on 03. We've got other ones that have inverted or now going down on the activity index. We've got a really nice increase. Oh, wow. Take a look at 30, you all. We hit 6.9% activity index in 30, and now we're at 25%. And that's a good zip code. That's not a bad zip code. That's, decent price zip code. You've got $1.9 million average price, 1.3, and you've got an activity index that has absolutely exploded on that zip code. So for those who worked at 3.0, really nice activity. You go to 3.4, Lakeway area, and you've got one of the worst activity index of the year, worst one going back 11 months. 3.5 doing very well. 4.1 just fell off down to 10.6. We've got a low on 4.5. We've got a low on 4.7. It's really just a mixed bag. 5.4. Look at 5.4. February, 54%. Right now, 19%. And just so you know, just by looking at this little heat map, where does that tell us activity is? So if you've got a listing coming up and you've got a client saying, what is the best time to put my home on the market? Let me draw a little square from January all the way through April. And look how many of them are just right there in that block. It's amazing. You've got Hutto. That's where the activity is. March, peak of the market. You've got February, January, February for 4.9, 5.0. You've got February, 5.4. You've got February. Manchac, same thing, February. This is a very early selling cycle market. You've got to come in hard. You've got to come in aggressive. Second week of January, third week of January, get that activity February, close in March. That's the kind of market that we have. Good news, you all. Bond market is now down 0.7 basis points. We are now inching closer to a repricing line on the positive for us. It is 11:09. We want to keep this at an hour. I want to honor y'all's time, but that is our Monday morning touch point. Went over a lot of things, shared with you some of the new resources that we have. Want to remind you, tomorrow, 10 a.m., mentorship meeting live in person here at the office. That is the only meeting that we do not record. So keep that in mind. That's the only meeting we don't record, is our Tuesday morning mentorship meeting at 10 a.m. We do have our Wednesday broker Q&A, contract review, and also our training module. We do not have a meeting on Thursday. That's when I update all of the stats for you all. I'll also be sure to update all of the, that's when we update the stats. And then we're also going to have the top 100. Okay, let me ask you a question over chat because I can't hear you apparently. When do you all want the top 100 published? Do y'all want that today? Do y'all want that tomorrow? Do y'all want that like next week? No, actually, that's not what I wanted to show you. I wanted to show you this right here. Okay, Sonia's asking for it this week. So here we've got this week. We've got, and I'm going to add the links for the meeting last week. Okay, so we've got this week. I'm thinking about, how about tomorrow? I think tomorrow's going to be a good day for the top 100. So we've got tomorrow, and then we've got Thursday, the stats. How does that sound? That sounds good, doesn't it? Top 100 opportunities available tomorrow. All right, let's go ahead and do that. Tomorrow, top 100 opportunities. We'll go ahead and get that bad boy published tomorrow. Do you mind emailing me, Sonia? Do you mind sending me an email? It's like, hey, top 100 tomorrow. All right, good stuff, you all. Well, it is 11:11. Thank y'all so much for joining. Super appreciate it. Let's go ahead and hit it hard. Have an absolutely amazing week ahead of us. Excited to end the year extremely well. Excited just to really just absolutely just kill it next year and this year. We do not have a meeting on Wednesday, Thursday, and Friday of next week. Let me go ahead and just kind of block that off. We do not have a meeting Wednesday, Thursday, and Friday. We also do not have a meeting on the 8th. No meeting on the 8th. What are we going to do with ourselves? No meeting on the 8th. I will be back in Chicago on the 8th. So no meeting on the 8th because it's a Sunday. But I will be in Chicago on the 6th, 7th, and 8th. Don't know if I'm going to be there the 9th. I have to check my flight. But I will be gone on, so we're not going to have 2 Friday meetings. We are having a meeting this Friday on the 22nd. And then we're going to have a meeting on, we're having it on Monday, of course. And stats. I'm not going to do stats on Thanksgiving Day. I might do it on the Wednesday. Maybe I'll do it Thanksgiving Day just for fun. We'll see. All right, y'all. Thank y'all so much for joining. Super appreciate it. Have an absolutely amazing rest of your day. If you have any questions, comments, concerns, criticisms, or complaints, let me know here to help. Otherwise, I will chat with you all later.